FXN Mentoring. What's up, guys? Welcome back to Trading with Market Makers, and welcome to week 5. So we're almost at the halfway point, guys, of the 12-week mentoring program. So with that in mind, I think a lot of the next videos, I'm always going to start off with something to kind of recap or remind you of in the following videos. So like we did in the previous week. So this week, the same thing. I want things to keep in mind. Last week we talked about entries, entry triggers and exits, right? And so a couple things to always keep in mind based on the homework that I was grading for you guys. So the first thing is, and I'm gonna sound like a broken record here on some of these, but it's so true. We're not just here trading every M&W pattern, all right? If you're looking at a sample, you have to understand that when you're doing the homework, it's easy to, I think it's easy to identify the pattern, right? Because you can see the entire picture, right? I think what you have to understand is that when you're in the real world, you don't have the entire thing to look at, meaning like you can't see, the entire trade yet. So when you're looking at entries, specifically entries, you have to have the mindset of, okay, if I couldn't see the entire picture, where is my entry going to be at? Okay. So keep that in mind, and this brings me to the point of we don't just trade every M or W pattern, because if you've seen some of the M's or W's that you guys are seeing out there are pretty like just trash, right? Meaning that they're a mess. Okay. And what I see a lot throughout the homework is you guys are trying to make a pattern there, even though it's not the cleanest pattern. But you're trying to make the pattern there so you could meet essentially like your requirements of whatever 20 examples of type 1s or 2s or 3s or whatnots. The point of the homework and the point of the assignments is I want you to realize what is a good pattern versus a bad pattern. And so whenever you see patterns that are very messy or that are very choppy, or the ones that I'm talking about that are just not very clear M's and W's, right? And you're really having to think about what's an M and is it really an M and W? Where's the first leg? Where's the second leg? If you have to go that in depth, it's too messy, and so you shouldn't really trade it. Because at the end of the day, it's just not worth it. It's just one trade. Okay? So please keep that in mind as we go into this week, and as you continue to look for patterns, back test, and all this stuff that we get into the following weeks. I cannot stress it enough. I want you to find the best setups, and there's a reason for that, because I want you to see and realize that not every day there's going to be an actual setup for you to trade. And that's just what it is. You have to understand that the things that I'm telling you, the rules that I give you, are solely based on the absolute best possible trade setups. And those are the ones that I want you to focus on and worry about trading. That leads me to my next point, is we only trade the best patterns that will produce the highest winning percentage. Same thing I told you last week. Okay? It's the same thing over and over and over again. I can't stress it enough. We only trade the best patterns. If the patterns are not clear, then don't worry about trading them. Who cares? You can't tell me that you can't find another pair to trade that day. There's like 50 other pairs to trade. The patterns must meet the entry rules that we've gone over in the previous week. Right? So I gave you literally a set of rules that have to be there for every single one, every single type. They have to be met before you can take the trade. That's what gives you the system in place to do the same thing over and over and over again. That's what basically builds the consistency. There's a reason why I give you the rules, is because they're very specific to those specific patterns. I want you to get the best results possible. I want you to trade the best trades possible. The only way to do that is to literally just follow the rules that I gave you. The setups that we trade are very specific for that reason. Is because it's a system in place with specific rules that we want to follow to get the specific patterns that we want to trade. Just because there's an M&W pattern doesn't mean that we're going to trade it. Doesn't meet our qualifications for the highest winning percentage trade setup that we want to trade. From now on, especially with the entry, after this entry triggers video that we had last week, everything moving forward, okay? Everything moving forward, we should only take trades that go with the directional bias. So meaning, you cannot take a trade until you know what your directional bias is. So if you know that you're just coming off a peak formation high, then you're looking for sells only. It's pretty simple. You're just looking for sells. I don't care if you get a type 1 buy that meets all of the requirements. The biggest requirement is the directional bias. And if it's going against the directional bias, then it doesn't meet the requirements to trade. So all the setups for the homework this past week that I talked about, the number one thing with the rules on the very first rule was what? Directional bias. Was to make sure that you had directional bias. All of these things that I'm telling you, it all leads to this. It's all about consistency. If you don't have consistency, you're never going to make it in trading. So the system that I give you has rules for a reason, right? And if you follow the rules, you'll just be consistent. And that's the point. Consistency is what's going to get you where you want to go. Don't worry about what other people, what other traders are doing. It doesn't matter what they're doing. They're not paying your bills. So who cares? Worry about your consistency, your trade setups, what you see based on the rules that I gave you. All right? So we're going to keep going on this week in the form of we're still going to be talking about entries, because I need you guys to understand the importance of the entries and exits. Because if you don't know how to correctly enter the trade or where to correctly enter the trade, that's going to be a huge freaking problem. Okay? So what we're going to do is this week we're going to talk about entries again. But now we're going to add into it, we're going to go ahead and add confirmations to the entry rules. right? So we talked about entry triggers. Now we're going to talk about confirmations. So the first set of confirmations is this. The more confirmations you have, the more likely the trade is to play out in your favor. Think about it, right? When you're looking at a trade setup and you have confirmations like pinning to the EMA or divergence on the TDI, followed by the correct timing, the pattern is there, it's in the right, the second leg is in the right box. The second leg gives you a railroad track. You get a pullback. Your directional bias is correct. These are all forms of helping you confirm the trade setup. The more of these that you have, essentially, the better you're going to be. Directional bias, the pattern, the timing, the 5 candles or more between the first and second leg, the EMAs and the TDI. Price rejecting or testing previous structure. When all of these come together, you have the perfect storm for a great setup like this. So here we have a type 2 setup where you can see the first and second leg. First leg is in between the Asian and London box, and the second leg is right there in the London box. There's more than 5 candles in between the first and second leg. Directional bias, by the way, is you're coming off of a freshly built peak formation low. So you're looking for buys anyways. Okay? So you have the pattern, you have the timing, you have the TDI. Look at the TDI down there. You see how the first and second leg on the TDI, the second leg is higher than the first, but on the actual price action chart, the first leg is actually higher than the second. That's divergence, right? That's divergence. And so that's a form of confirmation. So when you have all of these confirmations, it leads to a really great trade. And that's what I want you to focus on, is taking great trades. How clear is that pattern? Just ask yourself, how clear is that pattern? Some of the reason I harp so much on the pattern is because some of you guys turned in some homework, and the pattern that you guys were drawing out look at the New York box on this example. You guys were trying to make an M out of that crap in New York box. Okay? So you see the sideways movement in the New York box on this example. Don't try to make a pattern out of that crap. It only shows that you're just desperately trying to make something. So it is crucially important that we focus on trading clear patterns. Patterns that look like this type 2 W buy. Okay. So we're going to be talking about first about the EMAs. And then towards the end of the video, we'll talk about the TDI as well. So the biggest things that we're going to cover in this video is we're going to talk about confirmations, basically with the EMAs and the TDI. All right. So let's go ahead and get started here. So exponential moving averages. Okay, all of the lines, all of the EMAs that we use are all exponential moving averages. Why do we use exponential moving averages versus simple moving averages or just a regular moving average? The exponential moving averages puts more weight on current price action. Simple and regular moving averages don't. And that's really the simple answer why. So the weight of the moving average is more towards current price action. So it moves a lot faster. It reacts a lot faster than a normal simple moving average or a regular just moving average, right? So the moving averages that we use, the EMAs that we use, are the 5, 13, 50, 200, and 800. Now, if you're on TradingView, right, and you type in the indicators FXN, the buy and sell signal indicator automatically gives you the EMAs on there. Now, I'm going to show you how to do that real quick, just to make sure that if you haven't had them on your charts, that you know how to do it. All right, so if you're on TradingView, all you have to do is go up to the indicators and just type in FXN, and you will see where it says buy and sell signals, EMA 5 and crossover. That is the one that you want to put. Okay, so go ahead and double click on it and add it to the actual indicators on your screen. Now, one thing that I want you guys to do immediately, if you haven't done so already, is if you just double click on any of the EMA lines, right, it'll bring up the settings. What I need you guys to do is to go into style and uncheck the 365 EMA. We don't use that at all. So please make sure you uncheck it so it doesn't appear, because I don't want you making trading decisions off of a 365 EMA. Okay? Everything else you leave alone. It's just literally style and uncheck the 365 EMA. Okay? That's it. You can change the colors if you want to. I don't care. Do whatever it is that you want with that. Or you can just leave them be. Okay? But that's the main thing that I want you guys to do. If you haven't added the EMAs to the charts, now you know how to do it. And also, everyone, just make sure you uncheck the 365 EMA. All right? All right, so each EMA that we use serves a purpose. Every one of them has a purpose. If something doesn't have a purpose, it should not exist and it should not be used. So, what's the purpose of the different EMAs? Why do we use them? So the 5 EMA is used to help extend the current trade that you're in. So you've heard me time and time again, even in the last week's video, that if you want to go for more than 30 pips or more than 2-to-1 risk to reward ratio, and you're paying attention to the trade, you can do that by literally just following the 5 EMA. As soon as price crosses and closes above the 5 EMA, get out of the trade, right? Now, the 5 EMA is also used to help with entries if you're using a 5 and 13 crossover combination for the entry. Okay? The EMA, the 13 EMA, is used as an entry trigger. That's it. Is used to help with entering your trades if on a second leg M or W, if you don't get a railroad track, star pattern, quarter wood, if you don't get any of that, right, to get into the trade early, then you're basically waiting for price action to close below or above the 13 EMA to trigger the entry. Of course, followed by pullback. But that's what the 13 EMA is used for. Now, the combination of these two can also be used for a 5 and 13 crossover to help with entries. So if you're a super conservative trader, okay, and that's nothing wrong if you're super conservative, but if you're a really conservative trader and you want to wait for that 5 and 13 crossover, then for the entry trigger, then that's where you're going to use the combination for. Okay. Now the 50 EMA is the balance line, and it basically shows the intraday trend. Okay, so what's intraday, right? Intraday is basically throughout that day, right? The operating day. So the 50 EMA basically shows the trend of what's going on throughout that day. So basically, if price action is below the 50 EMA, guess what? You should be in a downtrend, right? If price action is above it, then you should be in an uptrend. But it shows it's basically the balance line. You'll see price action will interact with the 50 EMA every single day. Every day it'll interact with it. Okay? Also, the 50 will act as rolling or moving support and resistance. The 200 EMA is home base. Price action always comes back home to home base once it gets too far away. If you go to a chart and you look, you will notice, go look at a chart and you'll notice, if we look at this one here, you will literally notice every time that a big move happens and price gets too far away from this gray line here is the 200. Every time price action gets too far away, it has to come back home to home base. Same thing in a downtrend. Too far off, guess what? We're going back to home base. Too far off, going back to home base. The 200 EMA is basically home base. The higher time frame that you go, the more obvious it becomes. You can see every time that it gets separated, it goes back. Every time it gets separated, it goes back. Every time it gets separated, guess what? It goes back. Okay? So this 200 EMA is home base. Anytime price action gets too far away from home base, it will go back to it to reset. That's why you will see price action have resets, right? The market maker cycle will reset at the 200 EMA. That's why the majority of the resets that you see happen at the 200 EMA. The 200 EMA is also used as a take profit, right? When the EMAs are not in our favor, or when the EMAs is in our favor, meaning that they're either above us or below us and we can use them for take profits, we're going to use the EMAs for take profits, especially the 200. Also, the 200 EMA also gives us a 1 hour chart trend, because on a 15-minute chart, the 200 represents the 50 EMA on a 1 hour chart. So if you're on a 15-minute time frame, just by looking at the EMAs, at the 200 EMA, you will know where the 50 EMA is on a 1 hour chart. So the 200 EMA also gives you the 1 hour chart trend, because it basically represents the 50 on the 1 hour chart. The 800 EMA gives us the 4 hour chart trend, because the 800 EMA on a 15-minute chart represents the 50 EMA on a 4 hour chart. So if you're on a 15-minute chart, essentially you can see or know what the trend is, what the intraday trend is, just by looking at the 200 and the 800 EMA. Meaning that if you're on a 15-minute chart and you look and you see that price action is below the 200 EMA on a 15-minute chart, that means that on a 1 hour chart, the 50 EMA is also above, price action is still also below the 50 EMA on a 1 hour chart. The same thing for the 800. If you look at an 800 on a 15-minute chart, let's say the 800 is above price on a 15-minute chart, that just basically means that on a 4 hour chart, the 50 EMA is also above price still. So whenever you have the 800, the 200, the 50, all of them, let's say, in the same trend or the same direction, right? Let's say the 50, 200, and 800 are all above price. Okay, that means that on a 15-minute, 1 hour, and on 4 hour chart, the intraday trend is a seller's intraday trend, meaning the prices are going down. Okay? Now, what could we take out of that? Essentially, one of two things. If you're just coming off, let's say, in this example, just coming off of a peak formation high, right? And you're just coming off of it, and you have the 50, 200, and 800 or above price, it's a really, really good confirmation for sells, right? Now, on the flip side of that, if you've come off a peak formation high and you've gone 3 times ADR already, right? So you've gone down 3 times ADR, and price action is still below, meaning the 50, the 200, and the 800 are still above price. What does that give you an option for? If you're at close to 3 times ADR and you get, let's say, a buy setup and you're already at 3 times ADR, what does that mean? It means that essentially you could use the EMAs in your favor in a trade setup to use them as take profits, right? Only because you've already extended 3 times ADR, so you are expecting a reversal to come anyways, right? We're not coming off of a peak formation high. We've been off of a peak formation now for 3.5 times ADR already. So we're at that point where we're expecting a reversal. We're expecting a new peak formation low to form. So if we see that, we can use that in that specific situation for the EMAs to use as take profits.
All right, so this is pound. This is what pound USD would look like on the right. This is what it would look like here on a 15-minute chart, right? So on a 15-minute chart here, look at where the 200 is right here, right? So the 200 is basically above price. So on the 1 hour time frame, this line here represents where price is on the 1 hour. So if you look at the 1 hour chart, here's the 50, right? And you can see the 50 is right above price. The same thing here where the 200 is. This represents basically where 200 represents where the 1 hour chart is on a 50 EMA. So if you look at, like, let's say a 4 hour chart, if you look on a 15-minute chart, here's the 800, right? That's literally right touching. It's literally touching the candle right here, right? So this 800 represents the 50 on a 1 hour chart or on a 4 hour chart. So look what happens on a 4 hour chart. Look at the 50. It's literally touching price right here. Same thing. So if we go back here, let's say, just to make it an easier visual, So if we look at this spot here on the chart, this range is basically like July 16th through the 20th. If we look on on the chart here, here's July 16th through the 20th. So what I want you to notice is essentially that spot and that spot. So this is a 15-minute chart, this is the 1-hour chart. Look at the 200, right? 200 is above price. This 200 line represents the 50 EMA on a 1-hour chart. So if you look at the 1-hour chart, the 50 EMA, this is what that 200 is representing. It's just basically telling you that, hey, on the 1-hour chart, price is well below the 50 EMA, which it is. Same thing on the 800 EMA here. If you look at the 800 EMA on a 15-minute chart, and then we look at it on a 4-hour chart on the same thing, you could see the 800 on a 15-minute chart is well above, obviously the 200 and everything like that. Well, the 800 here on a 15-minute chart represents the 50 on a 4-hour chart. So you can see it's just basically the same thing. It's just telling you that the 50 is still below price on a 4-hour chart. So these higher EMAs basically allow you to confirm the directional bias on a higher time frame without switching to a higher time frame. Because if you go to a 4-hour time frame and you see that price action is trading below the 50, that trend is down, right? Or the directional bias is sell. Just like if you were to go on a 4-hour time frame and you were to see that the price action is above the 50, then clearly the direction, the bias is to go higher. Well, the same thing basically is on a 15-minute chart. Whenever you see 50, 200, 800, right, all of them, and price action is all below all of them, the directional bias is to sell. Now, the one thing that I want you guys to understand is that just because the directional bias is, let's say in this spot here, is a sell, doesn't mean that you're not going to get buy setups that happen. Because what do you think happens when we look at a cycle? When we look at a cycle like this, right, the EMAs are going to look like this. So you're going to have at least let's focus on the bigger ones, the 50, 200, and the 800. So the 50 is going to be like this. The 200 would be like this, and then the 800 would be all the way like this, right? So the trend, the bigger retail traders, they see this and they're like, oh, well, we're selling because the trend is to sell, right? And so the trend is your friend, so they want to sell. The problem is that they don't understand that price has already moved 3 times ADR, right? So they end up selling here to keep the trend going, but you should know better because it's 3 times ADR, so you're expecting a reversal. So whenever the big rule that I have is whenever the trend is obvious that a blind person can see it, it's time to start looking at, okay, did we pass 3 times ADR yet? Or are we close to 3 times ADR? because if the trend is very obvious, everybody obviously is going to want to go with the trend, because every book tells you to go with the trend. Every retail trader's book tells you to go with the trend, right? So if you see a trend that's very obvious, you've reached 3 times ADR, 3.5 times ADR, I wouldn't be looking for selling, I'd be looking for buying. You know, especially if you notice like crazy stuff like this right here, like a spike, like a V spike like that, I'd definitely be looking for more buys, not sells. So the EMAs themselves, you're using them for helping you confirm to get into trades for entry, right? You're using them to help you take profit, so you don't have to, do a trade where you're like, okay, where do I take profit? You just take them at the EMA. So if you're taking a type 3 here on this day, you know that you're going to the 200 EMA, right? So if you go to the 200 EMA, you're going to get about 39 pips or so. Or if you didn't use the EMAs, you'd just be going for 30 pips. Same thing here on this one, a trade out of the edge. 30 pips is just right here, where if you're using the EMAs as take profits, you're able to target 56 pips. You can see here a type 3 trade, again, pins to the 50. Here, type 2 trade, second leg railroad track, goes all the way up. It almost makes it to the 200 or to the 800. That would have been your target here. The reason that you're using ADR is you're trying to project out how far is price going to go before you get some type of reversal, right? If you can project out 3 times ADR, you're projecting out, okay, I'm thinking that price action should go somewhere in this area before I get, some kind of reversal. And if you can match that 3 times ADR with previous structure, so let's just say that, let's go over here real quick to this chart. If you can map out the 3 times ADR, let's say from this reset down, and if we move this line up just to see where it's at here, and let's just go up to a 4-hour time frame, you can see that that line goes straight through a bunch of structure that previously has happened back in early in the year. If you go back even further, right from that line, you can see it goes through that structure there, and then goes all the way back to friggin' 2018, where there's structure there. So if you can project all this stuff out into the future, you'll know at least where you should be at, or where price should want to go to. But for the EMAs themselves, since that's what we're talking about, on a daily basis, right, you're going to be using the EMAs mostly to just help confirm trade setups, whether they help you or don't, because there's going to be obviously times where when it won't help you because the EMAs are not in that area. So like here, if you see that you're bouncing off a 200, you're spiking a 200 EMA, you gotta ask yourself, why are you spiking a 200 EMA? Why don't you go through it? What's so magical about it? You know? There's literally countless of examples where price bounces off EMAs. And so bouncing off of EMAs are just simply used to help confirm. Think of the trade setups like type 1s, 2s and 3s as a checklist. Think of yourself of having a checklist of like, I don't know, maybe 5 to 6 things for each setup. So let's say if you're trading like a type 1, right? What are you looking for to help confirm that trade setup? I'd say obviously you're looking for the pattern, right? The timing. Those two things have to be in place, right? And then you can look for how many candles. So 5 or more candles. What else? Is it bouncing off? Or is it pinning, I should say? Pinning to an EMA. Do you have good confirmation on the TDI, which we'll talk about next? Second leg. Let's say railroad track or star pattern. So think about what we just made here of a quick list. If a pattern or type 1 setups that you're trading have the right pattern, the right timing, 5 or more candles between the first and second leg, they're pinning to an EMA, the TDI helps confirm, and then the second leg gives you a railroad track or a star pattern. That's 1, 2, 3, 4, 5, 6 things right there that are helping you confirm that a trade setup is good. How confident would you be in taking the trade setup when all these factors are in play versus just having a pattern and timing in play? So if you had a type 1 setup that gave you a right pattern and right timing, and that's all it gave you, versus a type 1 setup that gave you pattern, timing, candles, pinning, TDI, second leg row, which trade are you taking? So now imagine that every time that you take one trade setup or a type 1 trade setup, you're following this list here, and if all these check, you take the trade. If they don't check, you don't take the trade. So we're going to talk about this in the back testing part, because you're going to, when you have something like this in place, this allows you to look at the market in a very black and white way. It's either there or it's not there. If it's there, you take a trade. If it's not, you don't take a trade. So it takes your emotions out of trading. If you can take the emotions out of trading, you can have way better control over your wins and losses, and also your psychology. So key factors of the EMAs. On type 3 setups, you want to have a pin of the 50. Like for me, I don't take a type 3 setup that doesn't pin to the 50. On type 1 setups, you're not always going to get a pin to the 200, because clearly sometimes the EMAs are not going to be there to help you pin. But you see that there's going to be times right here where they are going to help you pin to the EMAs. And a lot of times you're going to notice this stuff as you're going into the London session. You're going to notice where the EMAs are. So if you're noticing that, price action is pretty close to an EMA, you're probably thinking, hey, I would want to set up that pins to this EMA. If I'm looking for a sell, let's say, let's say this right here, I'm looking for a sell here, and I see that the 200 is up here. Like, I wouldn't want price to come up here and pin that 200, because that would just give me a confirmation to take the trade down. But you can see, like, here it goes straight through, the 200 goes straight through it. You still get a pattern to trade. You actually get a second opportunity in the US session.
So, EMAs. We use them as signals for entries, meaning confirmations, right? When price action is pinning to an EMA, or let's say creating a type 1, and the first leg and the second leg is pinning to an EMA, right? That's a confirmation, right? We use them as targets for take profits, the 200 and the 800. They act as moving support and resistance, because as you guys have seen in plenty of examples that I've shown you even during the Sunday sessions, where the 50 EMA or the 200 blocks price from going any higher, let's say specifically like on a type 3 or a type 2 or something like that, right, where you get a type 2 pattern and it's pinning to the top of the range but also pinning to an EMA, right? Or sometimes you've seen where you're looking for a type 3 setup, right, and you almost get the price action to go to the middle of the range, but the 50 is like right below it a little bit and it's blocking it from getting right exact to the middle of the range, right? That's acting as support and resistance. We use them to help confirm trade setups. All right, so what does that look like? Well, here's an example. So here's an example of a type 4, right? Where you get a strong movement out of the Asia into London. You get a nice pullback. Where does it pull back to? It pulls back to the bottom of the range, which is essentially a type 4. Gives you a railroad track. And then it's also pinning to the 50. Right? So you have the pattern, timing, pinning to the 50. You have the actual railroad track pattern itself, good risk to reward ratio, and there's your trade. So let's take a look at some more examples here so you can see what they actually look like. So here we have a type 3 pattern pinning to the middle of the range, also pinning to the 50 EMA. Right? So the type 3 setup that's pinning to the 50 EMA, this type 3 actually gives us a second leg. So it's an actual M, right? So we have the pattern, we have the timing. Hell, we have, because it's an M, we have the 5 candles between the first and second leg. And it's pinning to a 50 EMA. There's your confirmation for a trade. Okay. The entry on this type 3 here is going to be that blue candle that's a pullback after that big red bearish candle. Because that big red bearish candle confirms the star pattern. Okay. So we get a pullback, which is that little blue candle. It goes back half the candle. That's the entry. Stop loss goes above the high of the star pattern there, and then you take it down 2-to-1 risk to reward ratio. You also get a second trade, which is another setup here in the US session, where you can see you get a star pattern, basically pinning to the middle of the range, but also pins to the 50 EMA. Right? So at the beginning of the US session, you get a star pattern for a continuation trade. Right? The entry is right after the star pattern. Okay? That's where your entry is. Another thing, this reminds me, another thing that I saw in the homework a lot is you guys were putting your entries like at the very top of the star pattern. I'm like, how could you have gotten that kind of an entry unless you have like a limit order or something like that? But there's no way in a real world scenario that you can get entries like that unless you're putting in a limit order. And that's where you're accepting, price action to go to get an entry. So I know it's easy because you guys can see the entire day of what happened, right? But that's not realistic to what you're actually getting into. Because the entry rules say that for a second leg you need to get in early on a trade setup, on a type 1, 2, 3, whatever. You need either a railroad track, a star pattern, a quarter wood to appear for you to get in early, right? Well, you need to let the damn star pattern actually complete and give you the pattern first before you can get in. You can't get in at the wicks because at that point you're just guessing. At that point you're just literally guessing. So I know it's easy because you can actually see the whole thing and yeah, it'll work out because you can see it. But you have to think in real time. You're not going to see that. You're not going to see that. So unless you're predicting, let's say a second leg to go to a certain spot off of a first, and you put in a limit order there, then that's a completely different, thing because price is going up to hit your limit order, right? But you guys have to think about the fact that, you're not going to have the luxury of seeing the entire thing and just playing it out like that. All right. So here's another one. Here's a type 1 pattern where price action is pinning to an 800 EMA. So the important thing about this one is that I want you to pay attention to is look at the apex of this type 1. The apex that I drew here of this type 1, the second leg, doesn't give you a star pattern, a railroad track, or any of that stuff, right? Because the railroad track that you're seeing there is actually not 5 candles between the first and second leg. So I know that that's not the second leg. The second leg is where I drew it at, where that pin bar goes up to. So that pin bar, that red pin bar candle that comes down doesn't cross over the 13 EMA, right? So the next candle does. You see how the next candle closes below the 13 EMA? That's the entry trigger candle, right? And so the next candle after that gives you half the candle back on a pullback, and that's where your entry actually is. The little blue doji candle that pulls back after it crosses the 13 EMA, that's your entry candle. Okay? This one. Here we have a type 2 pattern. And notice how the EMAs are all running through price action. Right? How the 50 is running through price and the 200 is running through price. The pattern is still there, and you still use the EMAs because the 200 EMA is actually holding price action from going up any higher. It's acting as a form of resistance, right? So in this case here, the second leg in this case gives you a railroad track, which allows you to get into the trade right after that railroad track. The stop loss goes right above that second leg, and you see what happens with the rest. Here we have a type 3 pattern, and in this example, you can see how the 50 EMA acts as a form of moving support and doesn't allow price action to get right exactly to the middle of the range. Okay? So anytime that you see this, anytime that you see where the 50 is preventing price action from getting to its destination, in this case, getting to the middle of the range, right, to help confirm the type 3, this is still a good trade setup to trade. We know that it's still a good setup because we know and understand that the 50 is acting as moving support and it's preventing it from getting to the middle of the range. You still get the pattern. You still get a type 3 pattern at the right time with a star pattern right there. The entry is going to be on the pullback of that red doji candle that gives you damn near a huge pullback all the way back to the bottom. You get a great entry on this. You get a really good entry on this. But this is an example of where the 50 prevents price action from getting to its destination of basically the middle of the range. Everything else is still there. You even, on this example here, you even get a reversal trade in the New York session. If you look at the New York session there, you see that big blue bar, the last big blue bar in London, that's your first leg. You have 1, 2, 3, 4, 5 candles with the railroad track. That creates the M for a reversal trade. Right? So you're in London, you're going with the directional bias, right? But we know that in the New York session, there's only two things that we're trading. It's either a reversal or a continuation, right? In this case, it's a reversal. We know that reversals aren't going to be like full-blown reversal trade setups. They're literally just going to be small reversals that go to the 50 EMA. So in this case, the entry is going to be after the railroad track. You get a huge pullback that you can use for entry. Your target is the 50 EMA. That's it. So in this one, you actually get two trades on the same day. Whether you're up to actually view the second trade or not, who knows. But this is a good example of you getting one trade during London and then getting the reversal that goes back to the 50 in the New York session. Here's another example. Another type 3. This one actually makes it or pins the middle of the range. Okay. But it's also pinning a 50 and a 200 EMA. So you're pinning both EMAs there. You see the 3 candle structure. This is not a railroad track, by the way. The big red candle followed by the blue candle that also pins, that's not a railroad track because that doesn't cover over 50 or 75% of the previous red candle. Right? So where's the entry at? So the entry is after the big blue candle that closes below the 13 EMA, you have a candle that pulls back, that big blue candle that pulls back half of the candle. So that is your entry. The pullback on that candle is your entry. Remember, you have to be realistic about when you're seeing these actual patterns develop. As you get better, as you become, as you do more back testing and you become better at identifying the market maker behavior, you're going to be able to take trades way earlier than that. Okay? You're going to get better at taking entries way earlier than that. And that's perfectly fine. That's great. But you need the experience first to do that. You can't just start doing it automatically. Okay? You need to see thousands of examples over and over and over again. All right? But once you understand the behavior of the market makers, forget it. It's done. On this example also, you also get the same thing, a reversal. You also get a reversal for the New York session. You see the last big blue candle in London session. You get 5 candles that make up basically from the first to the second leg. And then you get a big red candle with a big pin bar there. That big red candle there is your entry trigger. The next candle gives you a pullback that goes back half the candle. That pullback that goes half the candle right where the orange dot is, that's essentially where your entry is for the trade. And then just take it down 2 to 1. One thing I want you to notice is you see how all the EMAs are literally running through price. So whenever you have a situation like that, you're going to notice that price action doesn't just go to the 50. It'll go 800, 200. It's all there because all of the bigger EMAs are there. It's all going to go to those EMAs. All right. So let's go ahead and talk about Traders Dynamic Index. All right, let's talk about that. So the Traders Dynamic Index, I'm literally going to keep it as simple as possible. All right. There's a myriad of different videos out there that show you a gazillion different things that you could do with the TDI. But I'm going to keep it very simple in what you should be using the TDI for. Okay? Because I only use the TDI to help confirm trades. That's it. I don't use it for anything else. I literally just use it for only a confirmation of trades. That's all I use it for. So let's get into it here. So on the TDI, so if you haven't added the TDI yet to your charts, what you're going to do, same thing, you're going to go to indicators on TradingView, and you're going to type in TDI. And you're going to get a crap load of TDIs that come up. The only one that I want you to worry about is the one that says, that's created by Jay Donovan, that says TDI Gold Mines edited by or for MMM. Okay, that one is the one that we want. Okay, just double click and get it onto the charts. Okay, now once you put it onto your charts, same thing. I want you to double click on the actual indicator here, and it'll bring up all the settings. I want to make sure that all of the settings that I have here are the ones that that match yours. So go ahead and just make sure that these numbers here, the 37, 32, 68, 62, that they match yours. Everything else is all the same. You don't change anything. You're literally only changing the levels here: 37, 32, 68, 62. That's it. So the TDI, I use the TDI to help confirm trade setups. How do I do that? For type 1 or type 2 setups, I look for divergence as one thing. So for type 2 and type 1 and type 2 setups, I'm looking for divergence. For type 1 and type 2 setups, you'll have the TDI at a 37 or below for a W, or 61 or above for an M. So what does that mean exactly? Let me show you. So if you're looking at the TDI, okay, the lines that I'm talking about, this one here, this 61, and then here is the 37 line. So meaning that if I'm looking for a buy setup, right, I'm looking for the TDI to be down here in this range to help confirm. If I'm looking for a sell setup, I'm looking for the TDI to be above or at this 62 or higher line, or 61 or higher line for a sell. That's it. Okay, and when I'm talking about I'm looking for the TDI, I'm looking for the green line. The green line on the TDI represents price action. Okay, all this is just an RSI line. Okay, it represents price action. The green line is where you see the divergence. And I'll show you what that looks like in examples here. Okay, so the green line is the price action. The red line is basically the trigger, the entry trigger point. Think of the red line as the same thing as a 13 EMA on the chart, where you're making entry trigger decisions off of that. So the same kind of concept. When the green line crosses the red line, right, it's like an entry trigger. Okay? The blue lines here are basically Bollinger Bands, is what they are. So a good form of confirmation is, let's say if I'm looking at the TDI and I'm looking for a buy, or let's say a type 1 buy, and you see how the green line comes outside of that Bollinger Band and then comes back in like that, that's a good confirmation. You have the green line moving outside of the blue bands, outside of the blue Bollinger Bands, and then coming in, and then basically you get a cross of the red and the blue line, and then also a move back up for a buy. Okay, same thing for here as well. Comes outside overextends and has to come back in, crosses, boom. That's a good confirmation. The yellow line here is called a market baseline. It's just a market baseline. It's basically the market baseline for retail traders. That's all it is. But the only thing I want you to focus in on are what you're going to use to help confirm trade setups. So if you're looking for buy setups, so if you have a price action is showing you a type 1 W, you're going to look for the TDI to be down here to help confirm that. Same thing if you're looking for a type 1 M, you're going to look for the TDI to be up here above in these two lines here. Primarily, type 1s are going to go above the 61, where type 2s are probably going to stay at the 61 or a little bit below. So kind of like this right here. So this would be like a good example for like maybe a type 2 W for the buy, right? Where it comes down and it basically just barely touches that 37 line here, kind of like this right here. You still get the crossover. You see the crossover there, the red line there, same thing. Okay. Funny enough, on type 3s, we're bouncing off the 50 line. So like this right here would be a good confirmation for a type 3. See how it bounces off the 50 line here for a sell. If it would be for a buy would be something like this, right? So it's bouncing off the 50 like this for a buy. So for buy is above the 50 obviously, and for a sell it's below the 50, bouncing off of it. Okay. What I just talked about, type 3 setups bounce off the 50 line on the TDI. Most importantly, I want you guys to know this. Not every trade will have a TDI confirmation. Not every trade will have a TDI confirmation. Does that mean that you shouldn't take a trade? No, it doesn't mean that you shouldn't take a trade. It just means that there's going to be some trade setups where the TDI just won't be helpful. Just know that up front. It's not a big deal. It's just what it is. All right? So not every trade will have a TDI confirmation. So what do all this stuff looks like on a real chart with actual real patterns? Well, here's one. So here's the type 3 setup. Okay, you can see the star pattern on the price chart. You see the entry on the pullback, right? Now look at the TDI. The TDI went above the 50, just like the price action went above the middle of the range. Same thing. You see that? Same concept. And look, you come down, it crosses over the red. There's your entry signal. That matches essentially with the pullback. Okay. So that's a type 3. Here's a type 2 setup where you have first leg comes down, creates the apex, 5 candles or more between the first and second leg. Second leg gives you a railroad track. Okay. I want you to notice this. Notice on the TDI how the first leg of the M is above or right at the 61, while the second leg of the M is well below the 61. But notice how on the price action, the first leg is lower than the second leg. So what does that mean? That is your divergence. That's your divergence. The TDI is basically picking up the fact that price action is going to go lower ahead of time. That's why divergence is so powerful. So if you can get the pattern, 5 candles between first and second leg. Second leg gives you a good pattern of a railroad track, star pattern, or whatever. And then you get the confirmation as well on the TDI like this with divergence. It's over. It's really over. All right. Here's another one. Same thing. Notice how the first and second leg on the price action, you're bouncing off. What are you bouncing off of? You're bouncing off the 200 EMA, right? For a type 2 setup. Second leg gives you a railroad track. Look at the TDI. The first leg is one that makes it all the way up to the 61 mark. Look where the second leg reads. It's all the way down there already. Good confirmation. Good confirmation. Here's an example of a New York reversal trade setup. And the same thing. Look at price action. First, second leg in the New York box. 5 candles between. Your directional bias, by the way, is actually to sell because you're still coming off a peak formation high. You get a railroad track on the second leg. And look, you get a pullback. There's your entry. Look at the TDI. The TDI, this is the type 1, obviously, right? So it's well above the 70. But look at the second leg on the TDI. It's all the way by 61 already. But on the price action, you could see the second leg came up to basically match the first, right? So there's your divergence that I'm talking about. There's your divergence that I'm talking about. All right. Here's another one. This is a type 3. You can see in this example a couple things. The first thing is you could see that 50 EMA is acting as a form of what? It's acting as a form of moving resistance, right? So it's preventing price action from going all the way up to exactly the middle of the range. But not only that, you still get a pattern though on a type 3, which is the star pattern. You get the big blue candle followed by 2 dojis and then a big red candle, right? So that's the pattern there. You get a pullback. That's the entry on the pullback. Look at the TDI. TDI is what? Bouncing off the 50 line. There's your confirmation. Here's another one. So here we have, I would say this is a type 1 because it's well above the Asian range. But look where the first leg is. The first leg is all the way over here, where it gives you a star pattern on the first leg. But the second leg, it doesn't produce the second leg until the New York session, right? Now I know that some of you in real life would actually maybe see the railroad track that produces during the London session, and that's perfectly fine, right? But either or, on if you see that as a second leg, you get a pullback for an entry. There's your entry there. If not, the entry is going to be on the second leg here of the opening of the New York session, where it gives you a railroad track and another pullback. Again, pinning to the 200 EMA, acting as rolling or moving resistance. But look at the TDI as well. Look how the first leg is all the way up close to the 70 mark, 67 mark. But look where the second leg it reads. Even if you're reading the second leg in the London box, it's below the 61 line, and it's even further down if you're reading it under the New York box second leg. But either the London second leg or the New York second leg is higher than the first leg of price action, but on the TDI is actually lower, right? So that's divergence. That's your divergence there. That's a really good confirmation. These are the type of trades that I want you guys to focus on. The trades that I'm showing you the right trades that I want you guys taking. I'm not showing you crap trades because I don't want you to take crap trades. Here's another one. So this is a type 2 pattern here. You could see on a type 2 pattern where the TDI, see how low the TDI comes? It's almost grazing the very bottom of that 37 line. But you see how it comes out of the Bollinger Bands and then comes back in? Look at the price action where you have the big pin bar, the big blue pin bar comes down, goes up. You get 5 candles between the first and second leg. Now, the second leg, you get a railroad track, which is basically your entry. But look on the TDI where the railroad track is. You see how it's already moving forward or higher, essentially. The second leg on the TDI is higher than the first. But on the price action, both legs are the same. There's your divergence. Here's another one. This is a type 1. And you can see I drew it out with 3 legs so I could show you the divergence, because the divergence on this one is truly, truly really good. So if you look at the divergence here, how bad it is when the first leg on the TDI is reading well above the 70s, and you can see how each leg after that gets lower and lower. But on the price action chart, it gets higher and higher. Right? Notice that. Divergence plays a huge part. Here's a type 3 in the US session. You essentially get a second leg railroad track on the in the New York session, right? So the first leg is actually right at the corner of the empty space and the first little line of the New York box. That gives you a star pattern. That's actually the first leg. Second leg comes down, gives you a railroad track. That's your entry. Obviously, you can enter after the railroad track gives you the pullback where the orange dot is. But look at the TDI, essentially bouncing, boom, off the 50. Bouncing off the Bollinger Band. You get the cross of the green and red, boom, there's your entry. Here's the type 3. And you can see we're getting a type 3 with a railroad track pinning to what? Pinning to the 50. After the railroad track is your entry. Look at the TDI bouncing off the 50. On this one, we're not worried about the type 1M down, or the type 1 down, because that's still in London. The directional bias is actually to buy, not to sell. Because we're still in London, it's not a reversal. You get what I'm saying? The reversals are only in New York session, so we're not worried about that taking that particular trade. If you're wondering why. We're just going strictly with directional bias. Here's another type 3. You can see this when we get two legs on this type 3. Same thing. Second leg gives us a star pattern with a pullback. That's our entry on the price action. It's pinning to the 50. And look at the TDI. It's pinning or bouncing off the 50 as well.
The only thing that I care about is whether or not, when I'm looking at a pattern, can the TDI help me confirm the pattern? So on this pattern here, on this type 1W here, we have price action, or in this case, the green line of the TDI below these two lines here. Right, so you see these two dotted lines here. This is where you want the lines, or the price action, to be when you're looking for a type 1 or a type 2 setup. So you want this to be somewhere here. Just like if you were looking for a sell, you'd want price action to be up here. Okay, that's one thing. Second thing is, I want you to notice how this right here would be the first leg. It comes up and then comes down for the second leg. Do you see how the second leg goes deeper than the first? Does everybody see that? Now, I want you to pay attention to that, because the second leg goes deeper than the first. Now look at the TDI, and the first leg here on the TDI here is right here. The second leg is up here. Do you see on the TDI how the second leg is actually higher than the first? So when you have that happen, and you have the opposite happen, that's divergence. So when you have one thing here happen on the price action chart, and then the complete opposite happening on the TDI, that's the divergence that you're looking for. That's a really good thing, because the TDI is already picking up the fact that this should be going higher. So here, where's the thing at? So this would be the first leg here, right? Comes up, second leg. Notice how the first and second leg are pretty much the same, right? They're on the same level, basically. But if you look at the TDI, the first leg is here and the second leg is there. So there again, you have divergence. Now, one thing that you're going to notice a lot of is the TDI is really early, in the sense of what you see this happening here, like this is called the hook, right? So whenever you see this behavior here like this, and it's outside of this band, of the blue bottom band like that, or in this case, let's say the top like this is called the hook. And so what you'll find, or at least what I found, is that a lot of times this hook actually happens on the first leg, not the second. So notice, the majority of the time you're going to notice this, is that this hook action comes into play a lot of times on the first leg, not the second. So in a lot of ways, this is already like, it's almost like pre-predicting the future. Now, so that's how that would work on those kind of examples, type 1s, type 2s. Type 3s, like this one, notice where the price action line is. It's right at the 50 on a type 3. And by the way, most of the time you'll also see on type 1s, 2s, or whatnot said this will literally make a W, or this will literally make an M. It's very, very common. This would be an example of a trade out of the edge, where the first leg is in Asian session, second leg is in the beginning of the London session, like I said before, that 445, 430 mark. And you can see the first leg is all the way down here. This is the second leg. It's already up here. But on the chart, it's the same, it's the same length basically. So it's like here, but on the TDI it's like that. This one here, same thing. Price is coming out of the Asian range, hitting the bottom, hits one push up to the middle of the range, straight down. You're at the 50 here, straight down. US session, you have first leg here, comes up, second leg here on a railroad track. But again, look where you are. That's the first leg, that's the second leg, that's the first leg, the second leg is like all the way up here. So you have more divergence. Price action is in the right place. It's down here. Again, you notice how the hook here that happens on the first leg. This would be a type 2 trade out of the edge. Here you don't get actually a good confirmation from the TDI. The only thing that you do get is you do get a hook, but you don't get, price action doesn't quite make it to the bottom. And that's generally kind of like almost expected, because it's a type 2 trade. The trade setups that come down here, like deep into this area here, into between the lines here, are going to be type 1 trades. Type 2 trades generally come up to only this top line here. Type 1s generally could dip down further, but they generally stay within this gray spot, or this area here. But type 2 trades generally come down to maybe here. But this is another example of a type 2 trade. First leg in Asia, second leg at the beginning of the US session, before the 430. You can see you get a pullback here. You still get, the tiniest of hooks, because it comes outside of the Bollinger Band here and then back in.
So, homework. What I want you to do for homework this week is I want you to find the patterns. This time we're going to focus solely on type 1s, 2s, and 3s. You notice how I didn't mention type 4s. I didn't mention type 4s because we don't use the TDI to help confirm type 4s. We use the TDI to help confirm type 1s, 2s, and 3s. All right. So I want you to find the patterns, type 1s, 2s, and 3s. I need 15 examples of using the EMAs as a form of confirmation. So show me 15 examples of actual trade setup, of good quality trade setups where the EMAs are being used as a form of confirmation. So meaning where the M or W is pinning to the EMA to help confirm the trade setup. Now, very important that on all of these examples that you're using, you have to be in the correct directional bias. Okay, so automatically thinking and putting this into your mind that no matter what, every single trade setup that you send or that you show or that you're looking for is always going with the directional bias. Okay, always. So 15 examples of using the EMAs as a form of confirmation, meaning where the EMAs are pinning to the M or W to help create confirm. Give me 15 examples of using the TDI for confirmation, meaning where the TDI itself is helping you confirm the actual trade setup. Give me 15 examples of using the TDI for divergence. And 10 examples of using the EMAs as a form of take profit. So 10 examples of you using on an actual real setup, again, with the directional bias and everything like that. So everything that you've learned correctly, okay? Directional bias, entry rules, pattern, timing, all that stuff, right? Using the EMAs for take profits. Of course, all the patterns must be within the correct timing. London boxes, second leg, all that stuff is I want that to be great. I want good quality setups. Not any setups just to get the homework done. I want the best possible quality setups. The reason I want you to work on the best possible quality setups is because I want you to realize just how many setups we're talking about. And you'll start to realize that we're not talking about everyday setups. There's going to be weeks, there might be a week or two where you get setups almost every day. There's going to be a week or two where you might get up only one or two setups for that whole 2-week period on that specific pair. Most importantly, each example must go with the directional bias, like I've said. I want you to label and draw out each pattern, mark the entry and exits of each trade. So essentially, just how you were doing it for last week's homeworks, where you were drawing the actual pattern, putting in the risk to reward ratio and all that stuff, you're doing all of that. This doesn't change. Okay, none of that changes. And I want you to use the ellipse tool to draw out the confirmations. So what do I mean by that? This is what I mean. So here's an example. We're coming off of peak formation high, right? We go into replay mode. Very important, go into replay mode. Okay, here's the pattern, right? So we draw out the pattern like we have it drawn out here. And then the ellipse tool is basically the tool where you draw the circle, where the little brush is. The ellipse is right here. You click on it, select it, and then essentially you can just draw out where the pattern is, and then select the ellipse again, and then here as well, where it's touching the 50 line here. It's bouncing off the 50 line here. Okay. So obviously you've drawn the pattern. Now put in your risk to reward ratio. So I know where your entry is. Okay. And then also, please make sure that you do this, guys. Please, please, please. Because if you're doing this, like if you're just drawing this like this, like how the hell am I supposed to know which candle specifically did you get in at? And that's the whole point of me. I want to know exactly what candle are you thinking that you're going to get in on this particular trade, right? So what you can do is you can use, if you go to where the T is, go to the call out, okay, and literally click on the candle right here where your entry is, and you can just type in entry on the pullback of this candle. And you could, you can write in here as well, type 3 setup. Okay, so something like that, where you draw out the pattern, you have your risk to reward ratio. Okay, this is actually a good example because you can use it for this example. You can use for a lot of for one of each, actually, because you can use this example here as one of the examples for the EMAs bouncing off for confirmation of the EMAs. You can also use this one for a form of TDI confirmation, and then you could also use this one for confirmation of using the TDIs to help take profit, or the EMAs to take profit. So this specific example, you can literally copy it 3 times or 4 times really for all of them, except for divergence, but just relabel it to that specific example that you're doing it for. Okay, so if you're going to use this specific example, let's say for the form of confirmation of EMAs, form of confirmation for TDI, and then let's say for EMAs of take profit, all you have to do is for whichever one you're using it for. Let's say if you're using specifically this one right here for the TDI, cool. You have it just like this. Take your photo, copy it, and then paste it to the email under, TDI confirmation, right? But then all you have to do is literally just do this. You can use EMAs being used for confirmation and price action is pinning to the EMAs, right? And then just take the ellipse, obviously, and you can rearrange it to just showing the fact that it's pinning to the EMAs, right? And then boom, take another photo, copy the link. There's your example for, let's say, for showing the EMA as a form of confirmation. And then literally for the other one, you can literally just move the ellipse down here like this. And then just change this being used for take profit. And there was a 200 EMA. Take profit on the 200 EMA. Like that. Boom. Take your picture, take your link. Boom. There's your there's your example for using the EMAs for take profit. So one actual setup has essentially allowed you to produce, 3 examples for the 3 different things that I'm looking for. Okay. So I know that writing or typing this stuff in is may seem like irrelevant, because I know, like me myself, I know what I'm looking at and stuff, but that's not the point. The point is that I want you guys to explain what you're looking at, what you're using it for, because I want to make sure that you know what it is that you're looking at and what it is that you're doing. So that's what I want for homework for this week. Thank you guys so much. I hope that you enjoyed this week's video, and we'll see you in the group sessions.